The stock market has been evolving over time. If we compare the 1950s, for example, to today, the way stocks are traded is completely different with the advent of the internet. Even the way stocks are researched has changed from using the library or newspaper to now where almost everything can be found online. Every year, the way investing is done changes slightly, especially as new technology is introduced and investors need to adapt. So this is stock market investing for beginners in 2020. In this video, we're going to discuss the following topics. What is the stock market? What are stocks? How do you buy stocks? How do you make money on stocks? Where do I find information on stocks? How do you pay taxes on stocks for both the US and Canada? And what should you do if you don't want to lose all of your money? What do you do if you don't have time for this? And what if you have no money at all? Now, of course, be sure to check with your financial advisor before making any investment decisions and have a look at our disclaimer below. And before we start, please subscribe to our YouTube channel. We would really appreciate your support in helping us grow our channel. Be sure to hit the bell button to be notified about our future videos as well. And if you want to support us further, please check out our Patreon at patreon.com/themarketisopen. So let's start with what is the stock market? The stock market is the entire collection of stock exchanges that allow people to trade shares of stocks that have been issued by companies. The stock market also broadly encompasses other financial securities such as ETFs or exchange-traded funds, or mutual funds which invest in underlying stocks. It also may contain other instruments for trading things like oil and gold or other commodities which don't represent stocks of companies but rather some underlying thing of value, which the stock market helps to facilitate the trading of. The stock market may also include derivatives such as stock options, but that's beyond the scope of this video. Today, almost all trading is done online and is managed by various stock exchanges. So when you trade through your online stock brokerage, they are connecting to the stock exchange which manages the particular stock you are wanting to buy or sell. The stock market is made up of multiple different exchanges such as the New York Stock Exchange as pictured here, which is the world's largest stock exchange and houses about 2,500 companies which are listed or available for trading through this exchange. The total market value of these companies is about $30 trillion. The NASDAQ is the other major US stock exchange, the second largest in the world and considered to be technology heavy, meaning that many US tech stocks trade here, with major ones including Microsoft, Apple, Google, Amazon, etc. And in North America, Canadians trade stocks through the Toronto Stock Exchange in Canadian dollars. Although large Canadian companies such as Royal Bank, Toronto Dominion, Enbridge, and Bell are listed on the New York Stock Exchange as well and can be traded in US dollars. So what are these things called stocks which are traded through the stock exchanges that I just spoke of? A stock represents a part ownership of a company. So here's what happens. Say a company, for instance Snap, which is the maker of Snapchat, comes along and says, hey, we would like to be listed on the New York Stock Exchange, meaning they want to raise money from investors in exchange for shares in the company. So they do something called an IPO, the initial public offering. They go to the stock exchange and say, we want to sell, let's say, 10% of our company to investors. So investors ask, well, how much is the entire company of Snap worth? We need to put a price on these shares that we're about to buy. So a bunch of bankers get together and they come up with a price for Snap. Let's say $10 billion for the entire company, which they believe is a reasonable number. The $10 billion is also known as the market cap or market capitalization of a company. However, there might be thousands of investors wanting to buy a portion of Snap, so we need to divide it up into little blocks called shares to make it easier for people to buy. So they choose an arbitrary dollar amount per share, let's say $10 per share, and therefore we would have a billion shares, each worth $10. However, Snap doesn't want to essentially sell the entire company to public investors, so as we said before, they only IPO 10% of the company in order to raise $1 billion. At $10 per share, that's 100 million shares that need to be issued for a total of $1 billion entering these public markets, which is 10% of Snap. But these 100 million shares will be available for trading on the stock exchange after the company's IPO. So you, as an investor, can now go and purchase, say, 100 shares of the company's stock. And so that's worth $1,000 since each share was worth $10 on the IPO. Now, the IPO is a one-time thing. When you buy shares from the IPO, the money goes to the company issuing the shares. But after the IPO, the shares trade on the public market, meaning investors only trade the shares of the stock with other investors. The company itself has no role in the daily trading activities of investors when it comes to the actual trades. So how did the stock trades take place? The role of the stock exchange is simply finding and matching buyers and sellers with each other. You don't actually go to the stock exchanges anymore as in the olden days, although people do work there and trade stocks digitally. Pretty much every bank has an investments division that comes with an online brokerage that allows you to trade stocks. These are brokers that connect to these stock exchanges and allow you to put your buy and sell orders through. One app that stands out is Robinhood, which is the one that has been creating the most buzz lately as they've brought no trading commissions to the industry, so you don't pay per trade. Normally, some discount brokers can charge between $5 to $30 per trade. Also, Robinhood now allows you to purchase fractions of a single share. So normally, in order to buy one share of Disney at $150 per share, you need at least $150. Now Robinhood will allow you to put in just $1 and own a piece of that share. So if Disney goes up 10%, your $1 also goes up 10%. Here's an example of what an order for a stock may look like. In this example, the person is trying to buy shares of a company called TD, which is Toronto Dominion Bank. It happens to be a Canadian company, so it's in Canadian dollars. However, the same company is listed on the US stock exchange in US dollars. So you might see a screen in your online stock trading account that looks something like this. At the top, you see the name of the company, Toronto Dominion Bank. The bid is $63.59 and represents the highest price that someone is offering to buy this stock. The ask is the lowest price that someone is trying to sell the stock. So there might be 100 people who have placed bid orders to buy and their asks to sell, and they get to choose the price, as we'll soon see. However, when the bid meets the asking price, or vice versa, we have a price agreement and the trade goes through. Of course, it's all managed digitally by the stock exchange. The last price of $64.25 seen at the top is the last successful trade that went through. That also happens to be the number that is used to value the company at the current time. And if the bid and the ask don't meet, then there's simply no trade. Now, change means that the stock is up 18 cents on the day, and the volume of 2.5 million is the number of shares that have changed hands so far that day. The market is currently closed according to this picture, so any order placed would apply for the next trading day. The market is open from 9:30 a.m. to 4 p.m. Eastern Time, Monday to Friday, and closed on statutory holidays. So now let's continue from halfway down the page. You would select your account with the money that you would use for trading. The action in this case is to buy, but you could also choose to sell. Quantity is the number of shares, so you might have to do some quick math since trading is usually done using shares. If you want to invest $1,000, you need to calculate how many shares you can afford by dividing the price of the stock into the $1,000. So 1,000 divided by $64 is 15 shares, and you want to round down to not go over the $1,000. If you try to buy 16 shares, you need to make sure you have the money to make that trade work. Then we come to the symbol, which is TD. Every stock within an exchange has a unique symbol, and that's the important thing to know exactly which stock you are buying. In this case, the user has selected the Canadian market. If you switch this to US market, it would represent a different stock. Next, you can choose market order, which means buy at any price. This is usually quite risky because anything can technically happen and you may not be happy with the price that you get. That's why it's always good and safer to set a limit order specifying the highest price you're willing to pay when buying or the lowest price you're willing to accept when selling. It usually doesn't cost anything extra to do this. The exchange will get you that price or better. Finally, you can make the order valid throughout the day. In this case, because the market is closed, it would apply for the next trading day, or you can specify the date to keep your order around. I also usually check the all or none box if it lets me, so that my full order goes through because it's possible but unlikely that only part of your order is filled. Usually there's enough trading volume on most stocks to fill the entire order, especially for smaller amounts of money. So how do you make money on stocks? So the point of owning shares is for you to make money, and there's two ways to do that. The first is with capital gains or share appreciation, meaning the price of the stock you just bought goes up. Let's say you buy a stock for $100 and sell at $150. You lock in $50 of capital gains. Secondly, dividends. Dividends you get by some companies just for holding the stock. Dividends are excess cash that the company has no real use for and pays out to shareholders once per quarter. Usually more mature companies pay dividends. Here are some examples. And companies with rapid growth tend not to pay dividends because it's more worth it for them to invest the money back into the company. When their income streams become more stable and they don't have anywhere else to invest that excess cash, they may return it to shareholders through dividends. Here we see a company like Lockheed Martin on the bottom left that pays out $8.80 a year, which results in a 2.24% dividend yield. So if you held the stock for a year and the stock did nothing, you would still make 2.24% in dividends just from holding the stock. So where can you find information on stocks? I guess the first step is to know what you're looking for. You want to immerse yourself in with the company that you're interested in and really try to examine it from all angles to figure out things like if the product is good, if the company has growth potential, if the financial statements look sound, and if you believe in the future of the company. Here are some ways to do that. I always like to start with companies for which I'm a customer or I use their product already. You'd be surprised as to how many people own shares of companies that they have no idea what the companies even do. But at the same time, you'll also be surprised with how many companies you already know and use their product and they're publicly traded companies. I find it's useful to start with a company you know because you get a big advantage in understanding how the company makes money as well as how their service works. Now, just because your particular McDonald's that you visited on Sunday gave you poor customer service doesn't mean the company is suddenly terrible, or even a great experience can be misleading. You need to look beyond that because your single experience may not represent the entire company. However, a good place to start is thinking about the companies you already know. Besides searching your own thoughts, the next best place to look is usually the company's website, which is full of information about the company, sometimes including what the company is working on. Or you may notice some flaws with the company website as compared to competitors, for example. Maybe their ordering form is confusing, which could be hurting sales. Company websites also have an investors section. A quick way to find this is by typing the company name plus the letters IR into a Google search to find their investor relations page. This is useful for companies like Facebook, where going to their website and trying to find stock market information may be difficult because their website is their product. Their investor relations page shows information about the company financials, events, and press releases. Now, as I said at the beginning of the video, investing has changed over time. I think nowadays, if you truly want to keep up with the stocks that you own, you should follow them on their respective social media accounts. That's a great strategy for 2020, just to see what they're up to. Sometimes a company will post some new product or services here, and you'll be one of the first ones to find out. News articles are another great source of information. Websites such as Yahoo Finance, Bloomberg, and Google Finance provide links to articles. We've also built this into our own website, themarketisopen.com, and allow people to rank news articles they read pertaining to their specific stocks. Finally, companies report their financial results once per quarter. They then have a conference call to explain to investors their results. This is usually a good listen if you're interested in the company, though some conference calls can be a bit dry. That said, sometimes management provides valuable information about future quarters or about their plans during these calls. As we discussed earlier, there are two ways to make money on stocks: capital gains and dividends. And when you make money, the government wants its share. Here's how the tax system works in 2020 for both US and Canada. In the US, a short-term capital gain means you held the stock for less than a year. If that's the case, you pay regular income tax on it. However, a bonus of holding the stock for a full year or more is that the rates can be 0%, 15%, or 20% depending on your income. But that's significantly lower than the short-term gains tax. Now, if you get money from dividends from large US companies, which is considered qualified dividends, the tax rate is also favorable, and it uses the same tax rate as shown in the chart here, so most people pay about 15% tax. In Canada, capital gains taxes are 50% of your marginal tax rate for your regular income. For example, if your tax rate is 40%, then any capital gains are taxed at 20%, which is half of 40. Super simple. And it doesn't matter how long you hold the stock for, as long as it's not your day job. Then the government will probably want you to pay regular income tax. Dividends, on the other hand, are way more complicated in Canada. There's eligible dividends, which come from large Canadian stocks. Usually, tax software will calculate this for you, but say you make $100 from dividends. You have to gross up that number by 38% and add that number to your income. That sounds terrible, but to offset that, you get a tax credit of about 15% of that. It works out such that if your first $48,500 of income was all from dividends, you would pay no tax in Canada. But if you're getting all these dividends, you probably have some other source of income. The actual tax rate on dividends is still quite favorable and even better than capital gains tax until about the $100,000 income level. Okay, so your first question may now be, how do I not lose all of my money in stocks? So I started investing in individual stocks in 2007, right before the stock market crashed during the financial crisis. I had literally built my entire portfolio, and within a year, everything was cut in half on average. So to repeat myself, this video is mainly about investing in individual stocks. You should have other money outside of this portfolio of individual stocks. It depends on your age and where you are in your life, if you are living at home or if you need the money. A good rule of thumb is to put your first $10,000 that you want to invest into a low-cost index fund, which we'll talk about more soon. It's also good to always have some cash on the sidelines in case you want to invest more or if you need the money for other things in your life. This way, if the stock market takes an unexpected downturn, you still have money on the sidelines to invest more. The money you put into the stock market should be excess money that you're saving for retirement or for something special, not money that you need to pay your bills and such. Secondly, it's always good to be diversified within your stock market portfolio. Far too often do you hear people saying that they're all in, or they only own one type of stock in one sector, such as technology stocks. That didn't work out for the people in the year 2000, or for the people who owned only oil stocks or financial stocks in the year 2008. Sometimes market forces only affect certain sectors of the market, whereas other sectors could even benefit. So usually in a portfolio of 5 stocks, they should each be in different sectors of the market such as financials, food, cloud computing, etc. Also, just because 2 stocks are classified as technology doesn't mean they will trade together or that a problem specific to one company will affect another company. For example, Netflix is a tech stock and Google is a tech stock, but Netflix is a subscription-based service that provides media content, whereas Google gets its money from advertising, and therefore they don't really overlap much. How much should you invest? So the amount you should invest depends on you. Usually, if a stock is very volatile, meaning it moves up and down drastically, it's good to wait for a pullback. You may want to start by putting in half a position. So if you were planning to invest $1,000, you can start by putting in $500 because you've researched the company and you believe in it. And if it goes down, you put in the other $500 at a better price. Worst comes to worst, it goes up before you made that second investment and you make slightly less. With platforms such as Robinhood, you can now invest in fractional shares, meaning you can invest $1 and still own a piece of your favorite company. Robinhood has no commissions, but if you do have to pay commissions with your regular brokerage, then I like to invest an amount such that the commissions are only about 1% of the overall transaction. So with $10 commissions, investing $1,000 makes the commission fairly negligible. Now, if you don't think you have time to research and to follow stocks in your portfolio, then you probably shouldn't be managing a portfolio of individual stocks. Buying a basket of stocks, such as an index fund that tracks the S&P 500, may be a better option. The S&P 500 makes up the top 500 stocks in the United States, and it usually outperforms most fund managers. Because it's also a fund that doesn't require any management, the fees are usually much lower. What if you have no money? Usually when you're young, it's the best time to invest in riskier companies that have huge potential, because if you lose all of that money, you can always make it back throughout your life. And if you hit it big, then that's great. But young people tend to have less money, so how would you invest if you have no money? Well, you need to start somewhere. The assumption is that you may be working, but your expenses take up most of your paycheck. One strategy is to take a small amount from each paycheck and invest that into your savings. Taking 10% off is almost unnoticeable, and after a few years, you'll be surprised with how much money you've saved. I'll also refer back to Robinhood again, and I don't use their platform, but for most people who do, even with almost no money, you can still buy shares in any company. They've really done well in democratizing the stock market and making it accessible to anyone. So we just touched on many of the details related to the stock market in this video. If you have any questions, which I'm sure you do, leave them in the comment section below and we'll try to address them individually or make another video if there's high enough demand for that. Please be sure to smash the like button on this video. And if you found our video helpful, please consider supporting us on Patreon at patreon.com/themarketisopen. Your support is very much appreciated. Also be sure to subscribe to our channel and please hit the bell button for future notifications. Thanks so much for watching.